Imagine this. The stock market is hitting new highs. Everyone on Twitter is bullish. Your group chat is full of,
Bro, I just bought this stock messages.
crypto is pumping. News channels are calling it a strong economy. And then, boom. The market crashes. Here's the scary part. Market crashes don't start with panic. They start with confidence. Right before every crash, the market enters what experts call the euphoria phase. This is when stocks keep going up, bad news is ignored, everyone thinks they're a genius investor. In 2000, people thought dot-com stocks could never fall. In 2008, people believed real estate was always safe. In 2021, people thought crypto would only go up. Same story, different assets. Here's the pattern. When everyone agrees the market is safe, that's when it becomes dangerous.
Very dangerous!
While retail investors are buying, something else happens quietly. Big institutions start selling. Not dramatically, not on headlines, but slowly. Why? Because smart money doesn't wait for crashes. They prepare before them. In 2007, hedge funds started reducing risk months before the crash. In 2020, insiders sold stocks weeks before COVID panic. In 2022, tech CEOs sold billions before tech stocks collapsed. Retail investors see charts. Institutions see risk. Before crashes, three signals usually appear. Markets become too calm. Volatility drops. Everyone thinks risk is gone. Only a few stocks lead the market. For example, in 2026, only big tech stocks are pushing indexes up. Most stocks are already falling. Debt explodes. Companies borrow more. Governments print more money. Consumers spend more on credit. This is the moment when the system looks strongest, but is actually weakest. Here's the truth. Crashes don't happen because of one event. The event is just the excuse. In 2008, it was subprime mortgages. In 2020, it was COVID. In 2022, it was inflation and rate hikes. But the market was already fragile. When the trigger hits, fear spreads faster than logic. And suddenly, everyone wants to sell, nobody wants to buy. That's when the crash becomes visible. Here's what most people never realize. By the time you see the crash on news, it's already too late to react logically. The real signals were there months before, but nobody wanted to see them, because optimism feels good, and caution feels boring. So, are we in the euphoria phase right now? The honest answer is, partially yes. Markets are showing classic signs of optimism. A small group of megatech stocks is pushing indexes higher, retail investors are aggressively buying dips, and social media is full of bullish narratives. At the same time, debt levels are rising, interest rates remain uncertain, and global risks haven't disappeared. This doesn't mean a crash is guaranteed tomorrow, but it does mean the system is becoming fragile again. Historically, crashes are not sudden events. They are slow processes that only look sudden in hindsight. So while everyone is busy celebrating market highs, smart money is quietly preparing for multiple outcomes, not just one. Maybe the next crash isn't close, or maybe it's already being built, silently. And the real danger isn't fear, it's confidence without understanding.
To know why government can't stop printing money, click on Right Video and subscribe.